This is On The Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On The Charts podcast, episode 190 for Monday, 8th of May 2017. The major talking point today is the expected victory of Emmanuel Macron in the French presidential elections. The 63.9% to 36.1% win was widely anticipated, and as such, the markets had a mute reaction. In the US on Friday, the main indices closed at record highs after a stronger than expected employment report. The S&P 500 closed at a record high, led by energy companies, telcos, and materials. Bulk commodities rallied late on Friday after big falls during the Asian session. Crude oil had a rollercoaster ride as well, initially plunging 3.8%, following a 4.8% drop on Thursday. Prices, however, hit a major zone of support before rallying back and closed well into the green territory. At the close, it was 1.5% higher. The chart of crude looks pretty interesting, especially in light there's been considerable selling by large funds over the last few weeks. Many of that selling has been from trend-following style funds that have closed or reversed long positions on the recent weakness. Analysts suggest the market has now pulled back to a neutral state, and the chart shows a very strong zone of support at current levels, which extends back to August late last year. Scott Goddard, author of the Global Chart Research Service, has been watching a large ascending triangular formation and looking for an upside breakout. However, this recent weakness has invalidated that pattern, but the confluence of this strong support zone, Friday's large rejection and reversal, is compelling for the bulls, at least in the near short term. There is scope that crude prices may have locked in a low here at $45 and could now return to the upper end of the range nearer $55. If that's the case, look for energy shares to find a good bid and trade higher into the weeks ahead. In Australia today, all eyes were initially on Westpac profit results. The bank announced a $4 billion cash profit, up 3% from this time last year. The result was slightly weaker than expected, and the bank also suggests it expects the housing markets to cool. Later in the day, building approvals seemed to confirm that. Its data slumped 13.4% in March, driven by a steep 22% dive in apartment approvals. Analysts quickly pointed out that this was the beginning of the end of the housing boom. In other news, a private equity firm has made a tilt at Fairfax Media for 95 cents per share in an attempt to split up the business. The crown jewel in the Fairfax business is the property listing business Domain, which could be listed as a new entity. The renewed interest lit a fire under media stocks, at least early on. Southern Cross jumped 6% before closing 3% higher. Nine Entertainment was 5% stronger, and APN rallied 4.6%. Also, ANZ went ex-div today. Other banks traded slightly higher, and at the close, the broader market was 0.5% up on the day. Sydney Airports continues to look quite promising and suggests further upside in the near term is imminent. The share price got a kick after releasing strong results back in February. However, analysts are now undecided about the company, or after the company passed up an offer to build and operate the second airport to be located in the western suburbs. Some analysts suggest the dilutive impact of the build has now ceased to be a risk, but also suggest the loss of the monopoly position in Sydney could be a longer-term negative, and that the trailing earnings make the current valuation quite high. Passenger numbers remain firm through the year to date, and major airlines continue to increase capacity through the facility. Technically, the current pattern progression is very positive and suggests further strength to test all-time highs toward that 750 area can be seen. However, rarely does the stock break into fresh all-time highs on the first attempt, especially in a weaker environment such as what we're seeing at the moment. So there's a risk of broader consolidation taking shape below 750, lasting probably a few months. Even so, that consolidation would build a strong foundation for continuation of the multi-year trend. Buying at these levels is probably a lower probability trade unless the market as a whole steps up to gear. Some better opportunity should lay ahead. My name is Nick Radge, and I look forward to seeing you on the charts tomorrow.
On The Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.